Welcome back, investors. Today's video is all about two powerful stocks to buy on the dip and hold for the next 10 years. PayPal, PYPL, and Dexcom, DXCM. Both companies have seen significant pullbacks in their stock prices, leading many to question their future. But I believe these dips are opportunities, especially for long-term investors who understand compounding and are willing to ride through volatility. So, over the next 8 minutes, we're going to break down exactly why PayPal and Dexcom could be excellent 10-year investments. Hello viewers, if you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us and remember to comment and share. Let's start with the big picture. Buying on the dip is not about catching the exact bottom. It's about buying quality businesses when they are undervalued relative to their long-term potential. History proves this. If you bought Amazon in 2001 after the dot-com crash, you endured years of volatility but saw gains of over 10,000% by 2021. The same with Apple after 2008. The stock market punishes impatience but rewards conviction. The dips scare away traders. Long-term investors, however, use dips as opportunities to accumulate shares of fundamentally strong businesses. Here's the math. If a company grows earnings at 15% per year, its earnings double roughly every 5 years. Over 10 years, that's 4x growth. If the stock trades at even the same valuation multiple, your investment quadruples. That's the power of compounding. But to benefit, you need to own companies that have long-term growth runways and durable competitive advantages. PayPal and Dexcom fit that description. PayPal is one of the most recognized fintech companies in the world. Founded in the late 1990s and spun off from eBay in 2015, PayPal has become a global payments powerhouse. It has over 430 million active accounts and processes nearly $1.5 trillion in payment volume annually. That's a massive scale. Yet, despite its dominance, the stock has fallen more than 70% from its highs. Why? Competition, slowing growth, and investor pessimism. But underneath the headlines, PayPal remains profitable, cash flow positive, and deeply entrenched in digital commerce. Let's rewind a bit. PayPal started as a disruptor in digital payments, making online transactions simple and secure. It quickly became the default payment option on eBay, and later expanded to millions of merchants worldwide. The acquisition of Venmo brought in younger demographics. And Braintree gave PayPal a foothold in powering payments for platforms like Uber, Airbnb, and Shopify. Over time, PayPal evolved from a payments tool into a financial ecosystem. And that ecosystem remains its biggest strength. Brand trust. PayPal is one of the most trusted names in payments. Scale. Hundreds of millions of users and millions of merchants. Network effects. More users attract more merchants, and vice versa. Product ecosystem. PayPal, Venmo, Braintree, Honey, covering payments, P2P, and shopping tools. This ecosystem makes it hard for new entrants to completely displace PayPal, even with competition from Apple Pay and Google. Financially, PayPal is strong. It generates billions in free cash flow annually. Its balance sheet is solid, with manageable debt. Margins have been under pressure, but management is streamlining operations. Importantly, PayPal's valuation is historically cheap, trading at a forward P/E far below its average. For long-term investors, this combination of profitability, brand, and undervaluation is attractive. E-commerce growth. Online shopping keeps expanding worldwide. Venmo Super App. Monetization potential remains strong. B2B services. PayPal's merchant solutions could drive significant revenue. Global expansion. still plenty of room for growth internationally. If PayPal executes, its earnings could compound meaningfully over the next decade. Risks include fierce competition from Apple Pay and Google Wallet, potential margin compression, and regulatory oversight. But PayPal's scale and adaptability have helped it navigate challenges before. Long term, it's more likely to evolve than disappear. Now let's shift gears to healthcare. Dexcom is a leader in continuous glucose monitoring, or CGM, devices for diabetes patients. Diabetes is a global health crisis. Over 530 million people worldwide live with it, and that number is projected to climb. Traditional glucose testing is painful and outdated. Dexcom's CGMs provide real-time glucose data without fingersticks. This technology improves patient outcomes and quality of life, and insurers are increasingly covering it. The demand for CGMs is exploding. Patients want less invasive, more accurate solutions. Doctors want better data to guide treatment. And governments want lower long-term healthcare costs. Dexcom sits at the center of this transformation. Its flagship G7 device is smaller, more accurate, and integrates seamlessly with smartphones and smartwatches. Dexcom's advantages include superior accuracy, industry-leading data reliability, brand trust, recommended by doctors worldwide, partnerships, integration with Apple, insulin pump makers, and digital health platforms. Data moat. Millions of users generating health data, which strengthens its AI-driven insights. Competitors like Abbott's Libre are real, but Dexcom continues to out-innovate and expand globally. Financially, Dexcom is growing revenues at a double-digit rate year after year. Margins are healthy, and the company reinvests heavily in R&D to maintain its lead. Over the next decade, global adoption of CGMs, expansion into new markets, and integration with broader healthcare ecosystems could drive enormous growth. Risks include pricing pressure from insurers, regulatory hurdles, and competition from Abbott. But Dexcom's consistent innovation and strong brand loyalty give it a strong defense. PayPal and Dexcom operate in very different sectors, fintech and healthcare. But they share the qualities of long-term winners: market leadership, scalability, and secular growth trends. Both stocks have pulled back sharply, creating potential buying opportunities. For investors with patience and discipline, these could be two of the best buy and hold opportunities for the next decade. So, are you buying PayPal and Dexcom on the dip? Drop your thoughts in the comments below. Investing can be daunting, but taking the time to educate yourself is crucial for success. Consider all options. Ultimately, the right knowledge empowers you to make informed decisions, while guidance from professionals can help navigate complex markets. Always approach investing with careful planning and a clear strategy, transforming uncertainty into a pathway towards financial growth. Remember, a well-informed investor is a confident investor. If you enjoyed this deep dive, please hit the like button, subscribe, and turn on notifications so you don't miss future videos. Thanks for watching, and I'll see you in the next one.